let's talk about traders and analysts, also known as the investment team. These are people that generate ideas, create investment theses, and actually put capital to work. But there's not just one profile for a trader or analyst. Let's take a look. Usually, within a hedge fund's investment team, there are traders and analysts. PMs, or portfolio managers, can be considered just a type of more sophisticated trader with their own portfolio. The specific roles usually are: first, a trader is the person who, executes trades. Maybe an analyst generated the idea and analyzed the investment for them, or maybe the trader generated the idea and did the analysis themselves. Both can occur. But regardless, the trader is the one that executes, that pulls the trigger, and puts money to work. A PM is a trader that not only executes a specific set of trades, but that has a full portfolio under their responsibility. They are usually more senior and manage more money. Naturally, this portfolio may have to obey certain goals or a certain strategy. And finally, an analyst is someone who participates in the planning of the trades and the generation of the investment thesis, but they don't actually pull the trigger. They may work closely with the traders or not at all. Depending on the fund type and strategy, the roles may vary in terms of operations, but these operations usually consist of 3 stages. The first is the generation of investment ideas, new ideas for trades, and usually all roles participate in this. There are weekly meetings in a fund and everybody is called. And the fund manager just asks what are some ideas to generate returns. In some funds, the analysts may be the only ones to generate ideas. It depends. But they have to come from somewhere. Then comes the generation of the investment thesis from an idea. This is validating an idea and actually creating a model for a trade, including the risk-reward profile and the profit target. For example, generating an idea is saying we are going to identify an undervalued stock and invest in it with a 2 or 3 month time frame. An investment thesis is saying we are going to come in at $27, we expect it to grow to 34, and we have a stop loss in case it goes wrong at 26. For example, usually the analysts are the ones that do these in collaboration with the traders who guide them towards reasonable theses and models. And finally, the actual execution of trades occurs. So you have an investment thesis that says invest at this time and get out with this reward or this loss. And you pull the trigger. Usually, only the traders and PMs do this. Notice that the size of the portfolios and the trades may also vary greatly within a fund, and it even varies more among different funds. So for example, if there's a fund that manages 1 billion, some traders may have at their disposal 20 million, 1 billion, or anything in between, or even higher and lower than the extremes. It all depends on the fund, the money it manages, and the number of people. Usually, when they perform better, they get more money to manage. And when they perform badly, some of their allocation is taken away. What are some examples? The first is going from analyst to PM. If you think about it, the analysts usually do everything in the trading process except actually trading. So for some of them, when they are ready to cross that line, they go from analyst to PM, or analyst to trader to PM, depending on their seniority. Then, for example, allocations may change, as we've touched on. If a fund has 4 billion, for example, and a specific trader is managing 200 million, if they do well, they may see that carve-out doubled or expanded. And if they have negative results, it can be decreased. This may occur not just due to individual results, but the fund's capital as well. So if the fund raises more assets, then everybody usually will have more money to manage. And finally, usually investors are the ones dictating the funds and portfolios. For example, if a fund is raised having at least 20% ESG investments mandatory, which is demanded by the investors, then this demand will trickle down to individual PM portfolios. Maybe every portfolio has 1 out of 5 mandatory ESG investments, or maybe there's one portfolio just for ESG and another 4 for other investments. But one way or the other, the investor demands are reflective in the trades. When they are not reflective, this is called portfolio drift, which means that the actual execution does not correspond to the original strategy. What are our key takeaways? The first is that traders and PMs are in similar roles. Well, they execute trades. The key distinction here is that traders usually perform smaller, loose trades, while PMs have full portfolios with specific strategies. Then, analysts do everything but trade. They are exactly like traders or PMs, except that they don't trade. They generate ideas just like them, and they create investment theses based on those ideas. But they stop there. And finally, this all depends on the fund. Some activities change depending on the specific fund. In some funds, everyone may generate ideas, or just the traders, or just the analysts. In some funds, the analysts collaborate with traders to generate an investment thesis based on an idea. Or in some funds, it's just the trader or just the analyst, and so on. So as we see, there are different types of positions, and there are also different tasks. While in different funds, different people can perform these tasks, usually investing capital is limited to only traders or PMs, and analysts usually evolve to these.